Hello, everyone, and welcome to the latest LPL Market Signals podcast. Jeff Bookbinder here, filling in for Ryan Dietrich with my good friend, fixed income strategist Lawrence Gillum. Our goal for today is to take good care of Ryan's baby. I feel a little bit like a teenage kid where the parents gave him the keys to the car, and our goal is to just not get in a wreck. How are you today, Lawrence?
I'm doing great. I'm excited to be here. I will try to do my best to not wreck the car.
Very good. I have confidence. So today we're recording this Tuesday, May 24th, 2022. Let's get into it. Here's what we're going to talk about today. It's not like Ryan's not with us, even though he's not, because he's traveling. We are using a lot of the content from what Ryan has been writing about bear markets recently. By our definition, 20% down, close to close on the S&P 500. We're not in a bear market yet, but we are very, very close. So we'll talk about four things to know about bear markets. And then we certainly got to talk about bonds because that's Lawrence's gig. So he'll talk about some of the things that he highlighted in the weekly market commentary this week, which you can find on LPL.com, about bonds starting to look more interesting. And then finally, we'll talk a little bit about what's on tap for the week with economic data and the Fed minutes. Of course, everybody's talking about this, bear market. First, will it be a bear market or not? And second, how much worse could it get? So we'll provide some color on this, but this is a chart of the S&P 500, and you can see here, on an intraday basis, we did hit a bear market. The S&P 500 is down 7 straight weeks, a little bit up this week so far as we're recording this, despite Tuesday's losses. Hopefully we'll avoid 8 straight weeks down. That 7-week losing streak, that was the first time in over 20 years that stocks have been down that much. Our view at LPL Research is that this 3,800 to 3,900 range holds, but certainly it's very hard to have conviction that it will. Certainly we've had very, let's call them active debates internally within the research department about best move for portfolios right now. We're being a little bit careful, but certainly having some discussions about maybe adding a little bit more risk. Now, Lawrence, I know you're not an equity guy, but what do you think investors should be paying attention to here as we think about whether S&P 500 can find a low?
Yeah, no, it's all about the inflationary environment at current, but then how the Fed reacts to that and those inflationary prints. We get an important reading on Friday, which I think we're going to talk about, but if our expectation comes to fruition and inflation starts to kind of roll over the course of the year, it should set up a pretty interesting backdrop for risk assets broadly and the equity market specifically.
Yeah, absolutely. The Fed and inflation is certainly key. This is where really, bond people, I think, are in as good a position or better to evaluate this environment as stock people, because certainly inflation is more of a focus for fixed income historically. So let's get into these 4 takeaways or 4 key things we think you should know about bear market. So here's the first one. Stocks tend to do well after entering a bear market. So we haven't gotten there yet, but if we do, the median gain for the S&P 500 over the next year has been 24%. So, obviously it's important where you start, but we certainly think there's some good returns ahead of us. And here's the chart showing you, this is from Ryan, showing you all of these numbers, right? After you enter a bear market, historically, actually, it's the median return of 24%. The average is 15. It's really important to highlight the big dispersion here, right? So if you look at the 12-month column, 1973 and 2008 were dramatically negative, right? Not just recessionary environments, but very bad recessions, right? So if we don't go into recession, or if we have a mild recession, which is certainly a possibility, then you're probably looking at something closer to this 24% median gain over the next 12 months. So keep this in mind. If we avoid a crisis, and this is where fixed income comes in, Lawrence, if we avoid a crisis where people are worried about companies going bankrupt, right? Nobody liked the results from Target and Walmart. And last night, nobody liked the results from Snap. However, I don't think too many people are expecting those companies to go bankrupt. So I think it's important to think about the credit markets and trying to distinguish whether we're going to have a full-blown recession and crisis, which certainly you saw in 2008, or if we're going to have something more, either a mild recession or no recession, in which case there's strong gains ahead. So are you seeing anything in the credit markets that worries you, or does this still look like kind of garden variety recession slash mild correction?
Yeah, it's more the kind of mild slowdown that we're all expecting. We have seen spreads widen a bit in the credit markets, but only back to kind of historical averages or back to averages that are more specific to time periods where monetary policy is being removed. But we're not seeing a kind of any sort of jump to credit conditions where defaults are expected to increase, frankly. So I mean, they're still relatively well behaved, despite the fact that we have seen spreads move a touch wider. But coming into the year, spreads were so tight and so expensive that this kind of backup in spreads is I would say normal, given kind of the economic backdrop that we're looking at on a go forward basis, but nothing that's concerning as it relates to an increase in defaults for sure.
Yeah, we'll certainly watch all that very closely, especially Lawrence. So here's point number 2. Once it begins, it can end fast or slow, right? The median number of trading days for bear markets to bottom once they start is 81, which is a few months. So that's not great, but 5 of them bottomed in less than 46 calendar days. That's fairly fast. So, if we enter a bear market this week, hypothetically, then that tells you that maybe by, early July, the bottom will be in. Bottoming is a process, of course. You typically retest, sometimes multiple times. At bottoms, you tend to have a lot of volatility, big swings in either direction. We're certainly seeing that. But if this is more of a growth scare or a mild recession, then we got a good chance for this thing to work itself out by midsummer, if not sooner. So here's the numbers. This is the calendar days to bottom. And again, there's a lot of dispersion. So, figuring out if we're in a really bad recession with a crisis, a financial crisis or not, is important, because you can see here, the average is 154 days to bottom after you start, but 81-day median, because there's so many of these that are, much shorter, right? So again, you just highlight 1973, really bad, 2001, really bad, multiple crises in 2001 when the tech bubble burst, and then 2008 and 2009, most of us remember how bad that was. Took quite a bit of time. So, if we're not in those environments, then it's very reasonable to expect this bottom to play out in just a few months. So moving on to number 3, recoveries. So that was just time to bottom, right? But recoveries from bear market lows, which is what people really want to know, right? When am I going to get what I lost back? It takes an average of 19 months. It's pretty long, but if no recession, 7 months. And here you see the numbers. So Lawrence, if you're right, and this is not a credit event with significant credit stress along with a recession, then the recovery can be pretty quick. I mean, nothing, I can't say never. It's going to be hard to beat the record in the 2020 lockdown recession, right? That bear market was over in a month. And then the recovery was just 5 months after a 34% decline. That was, of course, abnormal, very unusual circumstances. But if you have a bear market that's only down, let's call it 22%, as Ryan did in this study, you can recover your losses in 7 months. So that would suggest recovering by year end. So, that's frankly, that I think is the LPL Research base case. It might take a little longer. Every bear market's different, certainly if we get one. But it's certainly reasonable to think that this one, based on the economic fundamentals and the earnings fundamentals, and prospects for inflation to fall in the second half, that this one could be one of the shorter recoveries. So we would say closer to 7 months and a milder bear market than the, let's call it 27 months when the bear markets are bad. It takes 27 months on average to recover. So those are the 4 points on bear markets. Anything? Well, actually, here's the fourth point. Those are the 3 statistical analysis tables that I have for you. But this point's probably the most important. And then I'll go to you, Lawrence, for any comments to wrap up this segment. Bear markets always end, right? Every bear market has ended with stocks at new highs throughout history, and we don't think this one will be any different. They feel awful when you're in them. You don't know when they're going to end. You don't know how far down they're going to go. All we can do is study history and see what, historical analogs we can use to gauge what this one might look like. But nonetheless, we'll get to back to all-time highs again. We always have, and we'll do it again. So anything to add on bear markets, Lawrence, before we move on to bonds? Actually,
maybe just want to selfishly promote kind of our blog post that'll be posted to LPL Research today. Josh Whitmore, an analyst on our team, works closely on the fixed income strategy side with myself. He put together a blog looking at how bonds have performed during these equity market drawdowns, and I think to surprise no one, the bonds have actually performed really well during these environments. This year obviously is the exception. We started with really low rates to begin the year, and even lower rates last year. So the kind of the repricing within the fixed income markets has been painful and hasn't provided those diversification benefits. But we are seeing signs that now that we've surpassed 3% on the 10-year Treasury yield, we are seeing additional signs of diversification within bonds. So if this bear market does persist, or even if it gets worse, bonds, we think, are in a good position to help provide that diversification benefit that they provided all those many decades before today.
Yeah, that's a good teaser for our bond segment, which is coming next. But I just want to wrap up, the thoughts on the bear market by looking at sort of the key issues that'll, we think, determine where this thing goes. Of course, hard to predict, but you mentioned it up front, Lawrence. The 2 most important things for the markets right now are inflation and the Fed. They're, of course, tied together. We in LPL Research think that the Fed will take a pause at the end of the year. In fact, I guess Bostic, kind of sparked some speculation that maybe we'd even get a pause as soon as September. Not sure about that, but nonetheless, we think there'll be a pause at some point before the end of the year, and we're going to transition to 25 basis point hikes, not 50. But we need to see inflation come down. By far and away, the most important drivers of this market in the near term, we think. Of course, China is important right now because of the zero COVID policy and that impact on supply chains. And of course, Ukraine continues to drive commodity prices higher and contribute to inflation. We need to see some resolution there to help us with the inflation problem. So there are your concerns on the bottom here: inflation and the Fed, of course, Ukraine, credit markets that Lawrence talked about, zero COVID policy in China. Not just China's impact on supply chains, but China's impact on global growth. In fact, China's economy is slowing so much, it actually probably going to grow slower than the US this year, which is highly unusual. I don't even know when the last time that happened. It's been many decades. So we've got to watch that too. So these are things to watch as we try to gauge the market's next move. Now, Lawrence, here's the best part of this podcast. In fact, we're probably going to lose listeners after we do this and we segue into bonds. Lawrence, you are a master griller. And so one of the most interesting things, when you meet a bond guy, you think, how interesting is this guy going to be, right? He's a bond guy. But I found out about your grilling skills, and, and of course we've hung out in Charlotte when I was able to make that trip down there not too long ago. And I had a great time. So you're one of the fun ones. Tell the listeners first how many grills you have. That's question number one. And then what are you going to be making over Memorial Day weekend? That's question number two.
Yeah, no, I hope my wife isn't watching because I don't know that she fully understands how many grills that we have because I have
Uh-oh.
some under the deck here.
She's not going
But
to listen to this.
I hope not. I'll get in trouble if she does. But so I have 3 smokers, a charcoal grill, and then a gas grill. And at one point, because I am the fun bond guy, I've actually used them all at one time. So I've been we had some
Wow.
folks over and I had we had a lot of barbecuing, smoking, and that kind of stuff going on. So it was a good time. But if my wife's listening, just one.
Very good. And with that one grill that you have, what are you going to make this coming weekend? Well, by the way, we're going to take next week off from the podcast, and then Ryan will be back in 2 weeks. So I want to get out there in case I forget. We'll take next week off. But what are you going to be cooking? I also want to help with a brisket because I'm going to smoke a brisket here soon, and I want your advice.
Well, yeah, no, that's what we're going with. The first
Oh, great.
First of summer, and we want to kick off summer right, and we're going to smoke a brisket. We're going to hang out by the lake all weekend. It should be a good weekend.
Awesome. I love it. I'm getting hungry. I'm glad I had breakfast. Maybe bonds aren't quite as much fun as cooking out, but they're actually becoming a little bit more fun, right? Because people are actually getting some yield. So Lawrence, you did a great weekly market commentary. You can find it on LPL.com about how bonds are actually getting more interesting here. So why don't you take a few minutes here? I think we've got three charts and walk people through the bond market. Some listeners might be surprised at these valuation stats you've got here.
Yeah, no, for sure. It's been a incredibly difficult year for fixed income investors, core bond investors. They're down about 9.5%. If you look at the returns on the Bloomberg Aggregate Bond Index, which is that core bond index. So it's been a really difficult year. So it made us step back and think about the primary reasons why we own core bonds in our portfolios to begin with. And there's 3 primary kind of value-added propositions for core bonds. The first one is liquidity. Bonds are going to be the most liquid part of your portfolio, and to help you provide the ammunition, so to speak, if you wanted to reallocate into equities or anything else. So, historically, fixed income markets have been the most liquid within that portfolio. The second value proposition is the diversification benefits, which we'll talk about in just a second, diversification to equity market risk. And then finally, it's the income component, the total return component of the fixed income part of your allocation. And that's been, a struggle recently for fixed income investors to generate income. But because of the sell-off that we've seen in fixed income markets broadly over the past year, past 5.5 months, more specifically, yields and potential income on a lot of these fixed income markets are the best that we've seen in quite some time. So, the acronym TINA was a big reason why asset allocation portfolios were overly geared towards equities over the past few years, but and TINA stands for there is no alternative, as a reminder. But with the backup in yields that we've seen in most markets, fixed income is attractive again, and it's generating income again, and it's generating yields and potential returns that we haven't seen in over a decade. So, as bad as the fixed income markets and performance has been this year, on a go forward basis, we do think there's a lot of opportunity for fixed income investors, or even those investors that don't want to take on additional equity risks. There's a number of fixed income markets that are yielding more than some of these equity dividend strategies. So with a lot less volatility. So we can't stress enough that it's been a very difficult year for fixed income investors. But on a go forward basis, we do think the prospects have improved pretty meaningfully.
There's definitely been no place to hide, but for investors starting with new fixed income positions today, you're in as good a shape as you've been in over a decade.
Yeah, I mean, if you start the clock today and look forward 5 to 7 years, which we'll show a slide on why that's important, but with the Bloomberg Aggregate Index around 3.5% today, we think that on a go forward basis, again over the next 5 to 7 years, we think that you're going to average about 3.5% out of your fixed income returns without taking on a lot of risk. And we haven't had those types of yields in at least a decade. So we do think the opportunity set has improved. But so the chart that we're showing here on the slide is that starting yields are still the best predictor of future returns. So all the yields that we just showed on the previous slide, we do think that those are going to correspond to future returns because, frankly, it's all about the bond math, right? So within the fixed income landscape, we have a pretty good understanding of what to expect out of returns. So you get your principal back at par or above par if it's called early, and you get your contractually obligated coupons that you collect throughout the life of that investment. Because of those structural return drivers, the starting yields have corresponded, quite frankly, pretty well with future returns. So if you look at kind of the orange line, those are the subsequent 5 years after you buy fixed income, right? So and then the blue line is the starting yield. And so the fact that the orange line and the blue line are aligned and have been aligned over time, again, that's the fact that starting yields have been the best predictor of future returns, and we think that's going to be consistent on a go-forward basis because we don't expect the bond math to change, frankly, because it's contractually obligated. So fixed income is one of those asset classes where you're pretty certain what to expect on a go-forward basis, and that's starting yields. And as mentioned on the previous slide, those starting yields look fairly attractive.
Yeah, good stuff. And then you mentioned, Lawrence, that the bond market is now a better diversifier to equity risk. So walk listeners through how this chart kind of makes that point.
Yeah, so this chart it's a little busy, but each individual line represents the 30-day correlation between stocks and bonds. So that just represents the relationship between stocks and bonds. So if stocks go up and bonds go down, you'll see a line below that zero line. But if stocks and bonds both go down at the same time, you're going to see a line above the zero line. So over time, there has been a negative correlation between stocks and bonds. It doesn't always hold. It's not always negatively correlated. Stocks don't always, when stocks go down, bonds don't always go up, but for the most part, they have. It hasn't happened this year, as we talked about earlier, because starting yields, back in the bottom of August of 2020, we plateaued at 50 basis points. That's not enough cushion for fixed income to provide those diversification benefits. Over the course of the last year and a half, we've seen a 260 basis point move higher in the 10-year Treasury yield. That 260 basis points is then able it's able to provide a more consistent drawdown experience relative to history. So when we've seen equity markets, for example, this month sell off, bonds have rallied, and that's what we would expect, kind of given that repricing of rates and the better cushion now that we have higher interest rates, within the Treasury market. So we do think the diversification benefits have improved significantly over the course of the past year and a half because of that repricing in rates. And it's one of the most important parts of our diversified asset allocation process is having equity diversifiers and the ability to kind of cushion those equity drawdowns. And we think, at the current level of interest rates, bonds can provide that cushion again.
Yeah. So while we're having some healthy debates about whether to add equities here at our investment committee meetings, we're also having some, debates about what to do with fixed income. And I think if we do decide to add some equities here, which would certainly be uncomfortable. Sometimes the best trades are the uncomfortable ones. It probably also makes sense to just ensure that our fixed income allocations will provide that ballast and be fairly, defensively positioned, which they are, right, Lawrence? They are.
We have had a pretty defensive fixed income posturing in our model portfolios for quite some time. First of all, we've been underweight fixed income broadly because we like the upside potential for equities. But within our fixed income allocations, we've been shorter duration, which means we've had less interest rate sensitivity in our portfolios relative to the Bloomberg aggregate index. Because we've seen rates move as high as they have, though, there's a discussion about increasing our duration, increasing our interest rate exposure to help offset those that equity risk that we're seeing and that we could see in the future. So we're not there yet, and we do think that there's maybe a potential for slightly higher rates than what we're seeing currently, but we think the worst of the rate move is behind us, and now we are starting to get a little bit more comfortable with adding duration risk to portfolios.
Yeah, we spent last year kind of shoring up our bond portfolios to make sure they could provide a little bit more cushion in terms of credit risk anyway. And we had some defensiveness in our rate positioning too. But like you said, there's really been nowhere to hide year to date. We invest with, by looking through the windshield, not using the rearview mirror, and certainly looking forward. Bonds look like good opportunities, and I'm certainly glad that we have taken some risk down in our fixed income over the last couple of years. So thanks for that, Lawrence. Let's transition to what to watch the rest of the week and wrap up. So the Fed minutes, from the May 4th FOMC meeting will probably get the most attention this week. Our chief economist, Jeff Roach, in his latest video talked about looking for supply chain comments. We have seen some signs of supply chains easing. And so hopefully the Fed will confirm that they're starting to see that too. It's one piece of inflation. There are a number of pieces to the inflation story, some of which I mentioned with the Ukraine-Russia conflict, but you've also got labor supply issues still. We'll see what we hear from the Fed. So that's probably the most important thing this week, other than just watching to see if the S&P 500 does indeed enter a bear market. We get some retail earnings this week, which have been mixed so far, continuing the theme from last week, mixed at best. We get the Fed's preferred inflation measure this week too on Friday. So we'll be looking for some deceleration there. This is really the start, we think, of the decelerating inflation data. It's going to be stubbornly slow to come down, but let's get started on that process right away. That can't come soon enough. So that's really kind of it for this week. Earnings season is losing its ability to impact markets, but it's certainly limping to the finish with the disappointments from Walmart and Target last week, and then today, or yesterday, disappointing results from Snap in the social media space, which is just highlighting just how hard it's been for the market to stabilize when these high PE growth stocks, mostly tech, have had such a hard time. But just to wrap it up, and then I'll go to you, Lawrence, for any closing remarks you may have. LPL Research still believes this is a growth scare, not a recession. We already had a negative GDP quarter. We think Q2 is going to be positive, and then maybe we'll have an acceleration from there. But the outlook is very uncertain. So it's going to be close. And so the market's pricing in probably 50, 60% chance of recession already with this decline near 20%. But if it is a growth scare, there's a lot of upside here. So that's why we're talking about, again, in that range of 3,800 on the S&P. We'll hope that holds. We think the medium to long-term returns from there will be very attractive. And even if it's a recession, we think it'll be mild. And it probably won't come for the next year. So that's, I think that's really all I wanted to get to. So Lawrence, anything else you want to add to all that?
Well, I mean, I think just to kind of underline what you just mentioned about the uncertainty, but the fact that markets have already repriced a lot of this uncertainty into the drawdowns, both on the equity side and the fixed income side. The rate market has sold off tremendously this year because of expected Fed rate hikes. We think a lot of that may be overdone, but markets are forward looking and they price in a lot of the uncertainty and negativity out there. So if there's just a small positive catalyst, we think that could really turn things around. So we'll be watching closely both on the equity side and the fixed income side for sure for that positive catalyst.
Yeah, well, in that PCE data on Friday, we'll also get consumer spending, consumer incomes. It'll be really important to monitor just how much inflation is eating away at consumer buying power, right? The upper half of the income spectrum is holding up very well. maybe it's that lower quartile of the income spectrum that you really have to watch to see how well their spending can hold up. We certainly saw some evidence of slowing consumer spending in the in the results from retailers last week. So consumer, really important in determining whether we get a recession or not. So that's not really a happy note to end on, but we're going to end on it anyway. So thanks everybody for listening. Thanks, Ryan, for trusting us with the keys. Hopefully we didn't wreck the car. Thank you, Lawrence, for joining. Really good discussion about bonds. People should certainly be thinking about fixed income here, maybe if they hadn't in recent years. We will be back in 2 weeks with Ryan for the next edition of Market Signals. So Ryan's, decided we decided to take next week off because of the holiday. So everybody have a wonderful Memorial Day weekend. Thanks for all of you who served our country, and we'll see you in 2 weeks.